Hi everyone, welcome back to my channel. Today we are diving into question 3 from the May June 2024 paper 2, variant 2-1. A fantastic question for anyone looking to strengthen their understanding of financial statements. Today we'll prepare an income statement and a statement of financial position, SOFP, step by step. So this is an excellent question if you're struggling with those topics. So then grab your pen and let's get started. If you take a look at the question gives us the trial balance, which lists the balances for the period as at 31st January 2024. And then you have some additional information. First, we are supposed to prepare the income statement for the year ended 31st January 2024. Remember, don't just look at part A. Please go through part B and C and the rest of the question as well, because sometimes it might be better if you do several parts simultaneously. So in this particular question, part A asks us to prepare the income statement, part B is the retained earnings, and part C is SOFP. So we can prepare all three simultaneously. So let's do it like that. First, when you get to prepare financial statements, don't go through the question and try to enter the figures straight away. Instead, first prepare the format of the financial statements. The income statement calculates the profit for the year, and it basically measures the financial performance of the business for the particular period. And how do you calculate the profit for the year? First, you take the revenue, you deduct cost of sales, and under cost of sales you have some components. First, opening inventory, and you add purchases. You deduct closing inventory, then you calculate your cost of sales. So revenue minus cost of sales will give you gross profit. And you add other incomes to your gross profit, but in this question we don't have incomes. So you can straight away go to expenses. So you deduct other expenses. After you deduct other expenses from gross profit, you will get the profit for the year. Part B is to calculate the retained earnings at 31st January 2024, that is the closing retained earnings balance. In order to calculate the closing balance, we need the opening balance. And to that opening balance, you add profit for the year, because basically retained earnings is the accumulated profit after you deduct dividends. So less dividends will give you closing balance. Part C is the SOFP at 31st January 2024. So we have non-current assets on top. How do you calculate non-current assets? So we value non-current assets at their net book value. How do you calculate the net book value? It's cost minus accumulated depreciation. That's why we have these three columns to enter the figures in the SOFP. Then you have current assets. You also have equity and liabilities, and in this question we don't have non-current liabilities, so we only list current liabilities. Right, then we can go to the question. Remember, here's an advice. When you get a question like this, don't start with the balances. First, tackle the additional information given, then go through the balances after you're done with all that. So the first information says inventory at 31st January 2024, that's the closing date, was valued at 4,720. So they have given the closing inventory balance. So we record closing inventory in two places, both in the income statement and in the SOFP or the balance sheet. So you can go to the income statement. So under cost of sales, we have less closing inventory. So you record closing inventory of 4,720. And also in the balance sheet, inventory falls under current assets because it's held in the business for less than a year. So then you record 4,720. Then point 2, depreciation on fittings is to be charged at 10% per annum using straight line method. So depreciation is when the asset loses its value, and when you record depreciation using the straight line method, you will have the same depreciation charge each and every year, because it's basically a percentage calculated on the cost. So 10% on cost. What is the cost of fittings? Fittings at cost is 18,000. So then under other expenses you can record depreciation on fittings. How do you calculate the depreciation charge? It's 18,000 times 10%, which is the depreciation charge, will give you 1,800. So that's the depreciation for the period. That's not it. We also have to record this in the SOFP. So fittings is a non-current asset because it's controlled by the business and it's held in the business for more than an year. And the cost is 18,000, which was already given. Then you can go back to the question and see the accumulated depreciation. So provision for depreciation of fittings is 5,400. And to that 5,400, we will have to add the depreciation charge for this period, which was 1,800. So when you add 1,800 to 5,400, you will get 7,200, and you will end up with 10,800. That is the net book value. Right. Point number 3, payment for advertising $75 is outstanding at 31st January 2024. Outstanding means it's accrued. It's an accrued expense because it's unpaid. It's unpaid at the end, so we are still liable. Since it's an accrued expense, you will have to add it to the advertising expense given in the balance, because $75 is relevant for the period although it's not paid. So we will have to add it to the 5,400 given. So 5,400 plus 75 will give you 5,475. Then that's not it. We also have a liability. $75 is outstanding. So it's an other payable. You have to record it in the SOFP under current liabilities, saying other payables. 75. Finally, no dividends were outstanding at 31st January 2024. That means there is no additional adjustment. We can just go ahead. So we are done with the additional information. Now we are left with the balances. We can keep on recording them. So first we have revenue, 78,000. We can record that, 78,000. Then purchases, 38,200. We can record it in the income statement, 38,200. Rent and insurance, 10,600. That goes under other expenses in the income statement. Director's salary, 19,000. It's also an expense, so it goes in the income statement, 19,000. General expenses of 3,420 goes under other expenses as well. Then we have dividends paid, 2,500. So this goes to the retained earnings calculation, 2,500. Inventory at 1st February 2023, this is the opening inventory. So opening inventory goes only in the income statement over here. Then we have cash at bank, 915. So this is a current asset. So we record it in the SOFP, bank, saying 915. Then we have trade payables of 2,288. This is a current liability, so we record it in the SOFP, 2,288. ordinary share capital of 13,000. This also goes in the balance sheet under equity. Finally, retained earnings. Now this is the opening retained earnings balance, 2,297. Just keep that in mind. If it's given in the trial balance, that's the opening balance, 2,297. So now we can calculate the profit for the year because we are done filling in all the information. So we can calculate cost of sales, which is 2,950 plus 38,200 minus 4,720, which is 36,430. And you deduct that from the 78,000 revenue, which will give you a gross profit of 41,570. Then you sum up the expenses. You will get 40,295. The difference between these two figures, the gross profit and the total expenses, will give you profit for the year, and that is 1,275. So you have the profit for the year. You can use that to calculate the retained earnings. So 1,275 is the profit for the year. If you add those two, you will get 3,572, and you deduct dividends paid, which will give you the closing balance of 10,072. So now that we have the closing balance of retained earnings, 1,072, we can use that in the SOFP. Record that there. Now you can calculate the balances. So we have a total of current assets of 5,635. You can add non-current assets and current assets to get the total assets value, which is 16,435. Then equity adds up to 14,072. Current liabilities, you have a total of 2,363, and when you add equity to liabilities, you will get total equity and liabilities of 16,435. As you can see, assets equal capital plus liabilities. So the accounting equation balances over here. With that, we come to the end of the calculations for this question, but we have a theory question. So the two owners of this business, two of the shareholders rather, are planning to increase advertising expenses by 100%. So we are asked to advise whether this is a good strategy or not. So we have to give 2 points in favor, 2 against, and then recommend. The first thing that I would say is that when you increase advertising expenses by 100%, it will attract more customers, which will help them increase the sales. Then, if the increase in sales is greater than the increase in advertising expenses, or if the increase in gross profit exceeds the increase in advertising cost, then profit for the year will increase. So those are 2 points in favor. But however, this could be expensive because it's a 100% increase, and the business may not be able to afford this. Sometimes this might mean that the business will have to borrow money in order to fund the advertising expense. So borrowing will also have some interest expenses. So this is increasing expenses even more. So in conclusion, I would say that it's best not to go ahead with this plan because there is no guarantee that advertising expenses will surely increase sales. So that's my answer, but there can be other points that you can mention. So if you have anything to add to this answer, please don't hesitate to comment below. And with that, we come to the end of this question. Thank you. I hope everyone understood.